I'm Kim Prophet. I'm a small business owner. I own Prophet Financial Solutions, LLC. Numbers guy. Been doing taxes for over 20 years. Investing over that same period of time. And just a student, always wanting to know about the financials, investing, taxes, those type of things. So I'm always learning. And I'm always teaching as well. I'm always giving that information away. I do it as a business, but, I love coming on to platforms like this where I can talk about it and help my people as well as anybody that's interested in knowing. So I've gotten a question a lot where people ask, okay, so what am I going to be looking like in terms of my taxes? Like, I made some money last year with Tesla and Apple and this and that. And now what is that going to look like? And so I started to explain it to them. And of course, a lot of it sounds like, Spanish. But, again, I try to break it down to them as easy as possible. So the first topic I'll talk about is that, which is short-term capital gains versus long-term capital gains. So I'll talk a little bit, give a little bit of backstory, which is most of us that are probably investing today, we work a regular 9 to 5. We have a job. So at the end of the year, we get a W-2, we get our taxes filled out, and we pay income taxes on those wages that we had. But we pay them as what they call ordinary income. Those wages are what they call ordinary income. So we have the different tax brackets that are associated with the money that you make on your regular job. Well, when you start investing in stocks, real estate, collectibles, other types of things, they don't get taxed as ordinary income because they're not wages. They get taxed as capital gains. And then you have two differentiations between capital gains, which is short-term and long-term. Now, short-term capital gains is when you hold an asset for less than a year, meaning like a lot of people are buying stocks and then selling them a week later. You're going to be taxed at the short-term capital gains rate. Now, if you hold something, a Leap, or you got some stocks that you've been holding for, 5 years, and then you finally say, okay, I'm going to capitalize on these and I'm going to sell them. Well, the fact that you held them for longer than a year, you're now entering into the long-term capital gains area. Now, the distinction between the two is that short-term capital gains is treated just like your ordinary income. Because of the fact that you held it for less than a year, you're going to be taxed on whatever you made off those stocks the same way that you're taxed on the income that you make on your job. Now, one thing about that, and people might not understand it, is when you talk about the tax brackets, and I can't roll call them off right now, but let's just say they were 0, 10, 15, 18, 22. A lot of people have the myth that the more money you make, the higher tax bracket that you'll land in, which is true, but they have the myth that all of your money is taxed at that rate, and that's not true. We're under a progressive tax rate system, which means that the first 10,000 is taxed at this rate, the next 10,000, and I'm just using figures, round figures to talk. The next 10,000 is taxed at the next thing, then the next amount is taxed at that. So it progressively gets higher. So that means that whatever is tacked onto the back end of your income, that's taxed at the highest rate. So if you think about it, if you're a worker and you make $50,000 a year, and then you made $9,000 in taxes, in investing in stocks, because essentially the stock part is not what you do on a day-to-day, that's going to be taxed at the higher rate when you talk about short-term capital gains. Now, this past, 4 years when Donald Trump was in office, they were, wanting to see his tax returns. And there was this thing where, he paid $750 in taxes. So that's one thing. Then you'll hear, especially when you talk about stocks, you'll hear a lot of people throw this story around where they say Warren Buffett pays less taxes than his secretary. And I have to qualify that when they ask me that or they say that to me, because Warren Buffett doesn't pay less taxes than his secretary when it comes to a dollar amount. They're talking about the percentage of his income that he pays. And that's because the majority of his money is being made in terms of investments. So they fall under that long-term capital gains tax. And you have 3 different categories for that. It's 0, 15, and 22%. Most of us are going to fall into that 15% range because the 0%, I want to say, is up to about 10,000. And it also depends on which filing status that you have: single, head of household, married filing jointly, married filing separately. But most of us are going to fall into that 15%. So that means that whatever money you made, no matter what, in terms of selling stocks, it'll be taxed at 15%. So with that being said, somebody like a Warren Buffett, the majority of his money is going to fall into probably the 22%, but it won't go any higher than that. But if you look at the ordinary income tax brackets, like for the workers, if you were to go make, $250,000 a year, $400,000 a year, your tax bracket for the IRS is going to be much higher than the 22% tax bracket. So getting into politics a little bit, this is why you hear the politicians going back and forth about the Republicans fighting for tax cuts for the corporations because they fall under that capital gains and those corporate taxes versus the tax structure that the Democrats push for the everyday working person. It's like you're giving the corporations or businesses the breaks because they fall in that 0, 15, or 20. I'm sorry, I said 22, but it's 20%. They fall under that, where we go up to a much higher tax bracket. So that's essentially how you'll be taxed on any income that you make from selling your stocks. Now, one thing for anybody that's a beginner, if you've bought stocks, you did not sell them, December 31st came and then it went, and now you're in 2021. If you did not sell that stock in 2020, you don't pay any taxes on it. You don't pay any taxes on it until you actually sell it and what they call realize a gain. So when you see that stock going up, but it's just still in your portfolio, you haven't sold it yet, those are considered unrealized gains. You haven't sold it yet. So you'll see it go up, down, up, down. You don't pay any taxes on that. You only pay taxes on the realized gains, which are when you actually sell it.
So Ken, let me ask you a quick question.
Yes, sir.
So on my E-Trade account,
yes, sir,
I do have a section called realized gains.
Yes.
So as that increases throughout the year, that's what I'll be taxed on for the tax season the next year.
Yes.
Okay, I got you.
And when you also look at that, and this goes for any of those accounts, Robinhood, E-Trade, TD Ameritrade, if you look at what Chad was just talking about, it should also break it down and show you what's characterized as short term and what's characterized as long term. So it's no shock to you how it's going to be taxed, because basically at the end of the year, just like your W-2, you're going to get a statement from whatever platform brokerage that you use. They're going to send you a statement, and it's going to break down all of your trades all throughout the year, and it's going to lump them into those various categories. So whoever prepares your taxes, like someone like me, we know how to characterize that when we do your taxes.
Only on UrbanSmartNetwork.com.